Ladies and gentlemen, good day and welcome to SH Kelkar and Company Limited's earnings conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during this conference call, please signal an operator by pressing star, then zero on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Anup Pujari from CDR India. Thank you, and over to you, Mr. Pujari.
Thank you. Good afternoon, everyone, and thank you for joining us on SH Kelkar and Company Limited's Q3 and 9M FY2026 earnings conference call. We have with us Mr. Kedar Vaze, Whole-Time Director and Group CEO, and Mr. Jagdish Agarwal, Group CFO of the company. We'll begin the call with opening remarks from the management, following which we'll have the forum open for a question and answer session. Before we start, I would like to point out that some statements made in today's call may be forward-looking in nature, and a disclaimer to this effect has been included in the earnings presentation shared with you earlier. I would now like to invite Kedar to make his opening remarks.
Good afternoon, everyone. For the order of matter of details, I would also like to inform that Mr. Ramakrishnan, CEO of Fragrance Asia and USA, is also with us on the call. With that, good afternoon, everyone. Thank you for joining our earnings call. On behalf of the management team, I am pleased to welcome Jagdish to his first earnings call with the company. He brings over 28 years of experience across manufacturing, telecommunications, banking, and a strong record in strengthening financial governance, driving operational efficiencies, and supporting business transformations. His appointment reinforces the company's focus on enhancing financial discipline and execution capabilities. Jagdish will begin with the overview of the financial performance and outline the key financial priorities. Over to you, Jagdish.
Thank you, Kedar. Good afternoon, everyone, and thank you for joining us for SH Kelkar's earnings call for the third quarter and the 9 months ended financial year 2026. Let me begin by saying that I'm excited to be with SH Kelkar at a time when the company is investing to build the next phase of growth. As the largest India origin flavors and fragrance company with a steadily expanding global footprint, it is a leadership business with a strong customer relationship and deep capabilities. And I personally see a significant opportunity to further strengthen execution and financial outcomes over time. With that context, let me now walk you through our financial performance for the period and outline the key priorities from a finance perspective, after which I'll hand the call back to Kedar to share his perspective on the strategic direction of the company. During the 9 months ended, the company delivered consolidated revenue of rupees 1,718 crores, reflecting a YoY growth of 10%, despite a challenging operating environment across certain markets. Demand remained resilient across our core categories, supported by continued tractions with both existing and new customers. Our performance during the quarter was relatively softer, reflecting a subdued environment and slower ramp-up in certain product categories. From a margin perspective, gross margins remained broadly stable during the quarter. EBITDA margins, however, reflected the current phase of execution, with costs associated with scaling strategic initiatives and strengthening organizational capabilities. On an adjusted basis, excluding the impact of new growth-led investments and high insurance cost, the EBITDA margin stood at around 13%. One of the key focus areas for me will be to sharpen our approach to cash flow and balance sheet management. As we progress through the current investment phase, debt levels may see a near-term increase aligned with our strategic initiatives and capacity expansion plans. At the same time, we see scope to improve working capital efficiency, which will be a critical lever in reinforcing balance sheet strength and moderating leverage over time. Another priority will be to enhance cash conversion and improve the translation of operating results into bottom-line performance. Supported by cost discipline, tighter capital allocation, and improved working capital execution. Ensuring discipline and well-prioritized capital deployment across the business will remain an important focus as we continue to invest for growth. While these initiatives will take time to fully play out, our approach will be structured and disciplined, with the benefits expected to emerge progressively over the medium to long term. And 2 months into these organizations, whatever the little insights I have, I feel that our focus is at right place. We are investing for future. Many times we don't see a quarter-to-quarter improvement, but definitely the initiative which led across the organizations to drive future sustainable, profitable growth is definitely going to pay out. It's a matter of time, maybe a medium term to near futures. We see that these growth initiatives are going to play in favor of the company. With that, I'll now hand over the call to Kedar for his comments.
Thank you, Jagdish. Building on his comments, the investment we are making today are aimed at positioning the company for the next phase of growth, especially in the global fragrances and flavors market. We are strengthening our global creative development centers, expanding capacity, and investing in capabilities that enhance innovation, execution, and customer engagement, especially across new markets such as USA, UK, and Europe. As discussed earlier, a key objective of these investments is to strengthen our competitiveness and positioning. The markets we are currently investing include UK, Germany, US, UAE, together account for nearly 75% of the global fragrance market, while India represents a relatively small share of around 5%. While the domestic market continues to offer attractive growth opportunities, we expect to participate in based on underlying FMCG growth. Expanding and scaling our presence in these international markets provides access to significantly larger opportunity in time and supports a more balanced growth profile. We recognize that this is an organic build out and will take time, with a horizon of over 2 to 3 years as capabilities scale and customer relationships deepen. Our experience in the flavors business, where earlier investments are now translating into stronger growth, gives us confidence that a similar trajectory can play out in fragrances over time. As part of this broader strategy, we have made encouraging progress in the US. During the quarter, our US Creative Development Center secured its first customer order, marking an important milestone in our entry into the world's largest flavor and fragrance market. While this remains an initial step, customer interactions have been encouraging, and the center is increasingly integrated into our global innovation and delivery framework to support both the regional and other multinational clients. Our 102-year heritage, we are now building stronger and more scalable operating platform with benefits expected to accrue progressively as capabilities mature. We believe that this is the right phase in the cycle to invest with conviction. As these capabilities scale, they will enhance our ability to capture opportunities, strengthen our competitive position, and enable us to drive consistent value creation for many decades to come. With that, I would now request the moderator to open the floor for questions.
Thank you very much. We will now begin with the question and answer session. Anyone who wishes to ask a question may press star and one on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Participants, you may press star and one to ask a question. First question is from the line of Jatin Chawla from RTL Investments. Please go ahead.
Yeah, hi, good afternoon, and thanks for the opportunity. My first question is, you mentioned in your opening remarks and in your presentation as well that you see this is the right time to invest, in these growth initiatives. What specifically do you mean when you say that this is the right time to invest?
If you look at the global competitive landscape, a couple of large companies, in particularly IFF and Firmenich, have undertaken large M&A transactions in the last few years, and they are now sort of reorganizing themselves, and this gives us opportunity for mid-size and the next level of companies to grow into these markets. We see that the market is over-consolidated with 3 or 4 players, and the business opportunity is more and more with large number of smaller clients with the direct-to-customer online e-commerce businesses coming over or taking over or starting over in many parts of the world. We see the opportunity landscape both from resources and opportunity for mid and small clients across the world at a very opportune time. This is kind of the cycle where new green shoots are seen in the FMCG business.
Got it. That's very useful. My second question is, at the start of the year, you had mentioned that your gross margins will be impacted in the first half, but in the second half, we will start seeing an improvement. But even in the December quarter, when I look at your gross margins, they are very similar to the gross margins in the first half. So now, is this the new normal for gross margins, or do you see an improvement? And if you do see an improvement, by when should we expect an improvement on gross margins?
So let me divide this into 2 parts. There is gross margin improvement on the underlying raw material availability and supply. As you know, the sales has been slightly muted compared to what we originally expected for this quarter. So part of the gross margin improvement will shift into the subsequent quarter as raw material at the older prices gets used up. So underlying business, as I look like for like, the gross margins have improved. This quarter we've seen some business, particularly global ingredient, having a little bit of negative headwinds, which has affected the overall gross margins. But we see the gross margin from a raw material point of view stabilizing and improving. Probably this Jan, Feb, March quarter onwards we will see improvement, or definitely April onwards we will be back on a very strong gross margin level. Partly currency exchange rates have also dampened some of the Indian rupee businesses from a gross margin point of view. While the dollar prices have come down, the rupee prices have not come down as much as we expected few months ago.
Got it. So, do we expect to go back to the 45% kind of gross margin that we used to enjoy earlier, or that will take some more time?
I think 45 last year was sort of the up cycle of the raw material where we saw very good jump. It will progressively improve. Whether it will reach 45 or a little bit tad lower than that, it all plays out. Too many variables based on the geopolitical and currency and so on and so forth. So I don't want to comment on that. I think directionally gross margins are improving across the board, and we will see benefit flowing in. We are at 42.4 or something. We are at the lower end of the gross margin range that the business will operate at.
Okay. And just one last question. India has signed a number of trade deals with UK, EU, and with the US also some sort of deal has been signed. So any benefit that we as a company see from these deals?
It's a bit early to know. I think when we get the fine print and we understand the dynamics of if any change has happened for our industry or related industries, we will be able to comment. So it's a good news that we have these FTAs announced and in the news. The fine print is the devil is in the details. So once we have the detail, we will know if there is any specific benefit that we will derive out of this.
Okay. Thanks a lot for allowing the questions.
Thank you. Next question is from the line of Dhaval Shah from Girik Capital. Please go ahead.
Yeah. Hi, sir. Thank you for the opportunity. Am I audible?
Yes. Yes.
Yeah. So my question is basically on the allocation of capital. So if you can help us understand over the last 2 years and going forward, how much capital are we planning? How much have we deployed and planning to deploy further in various geographies? In the center of excellence, as we call it, and as you see, a lot of opportunity in those countries. So if you divide between US, Europe, India, at various locations where you see there's a lot of opportunity. So how much capital has been deployed and how much more are you planning to deploy there? That's my first question.
Okay. Good afternoon, Mr. Shah. Let me answer this question. So when you talk about capital deployment, you mean to CapEx. And if I look at CapEx.
So, yes, so CapEx or acquisitions, what you have done. So, for example, in Europe, we have invested 80 crores so far. Right. Also, expenditure you do in the R&D and CapEx. Yes. So both. If any large money which is not giving you revenue immediately. So that sort of expenditure. Yes.
Okay. So when I look at outside India, we had capex going on into the Europe, and we have committed almost 7 to 8 million on that. A major part of that is already done. So I don't expect a much outflow out of India in next 6 to 12 months. It is going to be in the range of 2 to 3 million euro. That's what we are expecting. When I look at inside the country, you know that we had a fire 2 years back, and then 2 of our facility in Maharashtra, one out in Vasivili are going on for a construction phase. And that outflow will be there, but out of India, the expected outflow would be in the range of 2 to 3 million, and India would be in the range of 70 to 80 crores.
So India capex, you are expecting 70 to 80 crores, and what time frame?
This we are expecting in next maybe 12 to 18 months.
Okay, in 12 to 18 months. Okay, and all of this is going towards rebuilding Vasivili.
Vasivili and one out, 2 facilities are there.
Yeah. Okay, these 2 facilities. Got it. Okay. And next?
Just to add to that discussion, when the new second facility is built, we will close down one of the older facilities, and some operating savings on lease and other things will come down. So OPEX costs will reduce.
Okay. Understood. And so these are the 2.
One facility is a replacement. Second is a new facility which will replace the old facility in Mumbai.
Yes, understood. So this Europe, another 2-3 million, which will come to around say 25-30 crores, and 80 crores in India. So totally 110-120 crore is what we are going to invest over next 2 years, right? From the balance sheet.
Yes, we can say from now to 12 to 18 months.
12 to 18 months. Okay. And in the US, how much money have we put in so far? Beyond developing centers or any other capex there in the US?
In US, the development center is also already put in place, and that's sort of operational. Now we are starting our leased facility for a production, but in development center we had invested approx $1.5 million. $1.5 to $2 million in range of $1.5 to $2 million US.
Okay, got it. And any more? So then more expenditure there in the US side?
No, so we are starting this lease facility for a production. So those are going to be a business as usual, but I don't think that whatever we have as of today, that will continue.
Got it. So now coming to the second question, second leg of this question is the debt number which you mentioned in the presentation regarding it will be a slight increase. So we are currently at around 800 crores of debt and 100 crores of cash on the book. And if we see over the last 3-4 years, except for this the large fire we had, that has eaten up a lot of our cash flows. So what is the trajectory going forward? I mean, we are going to peak at around another 100 crores of debt on this, and how should we understand it? Because our debt equity ratio is really getting impacted, and the other side we are investing money for growth. But how are you planning to strike a balance? Because we are unable to make ultimately the ROCs, which, as an investor, you would want to see in this company. It is completely always under pressure. So, because I've been tracking this company since past couple of years. Initially, we had, things were going right. We had plans to achieve 17, 18%, 19% kind of EBITDA margin. It did happen also in between for a few quarters, and again, we are down. So, can you help us understand that what sort of time frame should we keep in mind to look at those numbers? What sort of balance sheet over the next 2 years, should we think, and what sort of ROCs, can it generate? Because we've done a lot of investments, and as per your business plan, where do you see where will be this company 2, 3 years down the line?
So with the limited insights and understanding I have in last 2 months, I can talk about more realistic situation, what I feel. You're right, debt level, we are right now, the gross is almost 800. And very frankly, we really have to do a detailed exercise to come back what would be the right number. But if I look at, I think it is going to be range bound, maybe somewhere in this range, or maybe 20, 30 plus and minus kind of a range. At least in immediate future, I see 3 to 6 months. For sure. When we look at a long term, other things are definitely is going to come back on.
Now, just to kind of, we are working out the detailed plan on this, so I don't want Jagdish to put out his neck on kind of a month into the company. I think we are 13% adjusted EBITDA as we speak. It will take 2 years of time for all the investments we have done over this year to start to generate positive cash flow revenues in Europe and America, particularly including UK and these markets. So currently, this quarter, what we call adjusted EBITDA without new initiatives is roughly 13%. I expect that to be 17% over the next 2 years. And we will put out a detailed, like a quarter-on-quarter, year-on-year execution plan in a couple of weeks, maybe 4 weeks, 6 weeks, as part of our budgeting exercise. I would just say that all the infrastructure that we need to operate is in place, and the opportunities are in place. Now, we understand that the cash flow and debt situation, we may not be able to take all the opportunities, so we'll need to focus on few and not or defocus or kind of defer a few opportunities. So we will take that up and create a strong road plan probably by April for the next 3 years.
Got it, sir. And sir, one last suggestion. So there are several investors who have been with the company since some time, and after the fire incidents and this investment phase, our market cap has also taken a big hit. As a if promoter could show some sort of more confidence by doing some creeping in the company, that would really restore a lot of faith in the company. So that just as a small.
I am tempted every day.
Okay.
I have been asked, in fact, in reverse, that don't invest or divest, just keep it steady, don't come in. But I am tempted every day at these values. So we will surely look at this feedback more strongly in the future.
Yeah, and sir, last is 10 lakh shares pledge which was created. What was the reason for this?
This is an old pledge. Only because the market rate came down, there is a trigger.
Pledge more shares. Yeah.
Again, it is undone because the market has a bit gone up. These are all, this is old loans which are already standing. These pledges will go up and down based on the market cap.
Got it. Great, sir. And sir, we'll hope to see you in person, soon.
Sure.
Okay. Thank you. Yeah.
Thank you. Next question is from the line of Henil Bagaria from Equicorp Partners. Please go ahead.
Thank you for the opportunity, sir. So just a few questions. So if you could also allude a little more clarity on the cost in US, both from the fixed cost side that is coming from the new creative fragrance center that we have and the new yeast rolling facility that we have there. And how much time will it take, or how many contracts or the size value contracts will it take to, I mean, reach a break-even point in the U.S. market?
I'm Ramkrishnan here. So basically, I think our investment in US has been more by way of OPEX than CAPEX. There's very limited or no CAPEX involved. So we have taken even the manufacturing facility on an operational lease for 5 years. We have already started winning business in the US, and our road plan is that at the end of next year, we should be able to win about $2.5 million worth of business.
So what will be the fixed cost the fixed operating cost for both the Creative Fragrance Center, the facility, and the leased rolling facility?
About between $3.5 to $4 million.
Okay. So also secondly, on the cash flow side, since we are going to put about 70 to 80 crores in the Vashavli as well as the new replacement unit we had, so this is going to be, we are going to actually file an insurance claim for this particular thing, right? So the cash flow is just going to be from our end initially, and then we will file it for the insurance claim to see and probably get most of it from the insurance side, if I'm not wrong.
Yeah, so insurance claim is already under processing, and we expect that should get settled in next 6 to 12 months.
Some
Okay.
incremental cost will be there for the second facility, probably 30 to 40 crores, but that will be not in the immediate year, the year after.
Okay. So and what will be the savings in the lease cost that we have, that we will save from the Mulund facility once we, should close it down?
3 to 4 crores of lease we will save in the Mulund facility.
Okay. So lastly, on the European side, is the facility on stream? Because I think so the existing facility is completely used. So we were actually planning to expand the facility and increase the capacity due to bottlenecks.
Q4, the new facility will be operational. Maybe end of Q4, March is the current expected timeline. So Q1, I expect both the new facility in Europe as well as the new facility in India to be operational. And by Q2 or Q3, they should be fully up and running. And the older ones, we will sort of the transition in between Q1 and Q3 when both are operating. And end of Q3 next year, Q1 calendar or Q4 financial, we should have the new facilities taking over the full manufacturing.
Okay. Sir, lastly, just an insight. So, since we are also doing business with the small and medium players, as well as the new emerging startups which come onto e-commerce and they're scaling up their business. So when there's an acquisition that happens by any of the large MNCs for these particular accounts, so what exactly happens post-acquisition? Are they integrated into the existing supply chain for the MNCs, or the existing vendors supplying fragrance, flavors, etc., are retained, and there is a periodic integration that happens?
So I think the integration with the bigger company, we have one or two examples like that. We have some companies which are acquired by Marico or which are acquired by Unilever and others. And our general business has continued. It has actually grown. We have been able to consolidate that and continue to grow. So there is no risk for us if the bigger companies acquire. Some of the startups do have suppliers who are much smaller or not, let's say, professionally organized, in which case that business does present opportunity for us for additional growth in this acquisition of any small brand.
Okay. Thanks a lot, sir, for the answering questions, and best of luck to the team.
Thank you.
Thank you. Next question is from the line of Riddesh Gandhi from Discovery Capital Management. Please go ahead.
Hi, sir. Just want to understand, when we internally look at our capex and investment, what typically are the hurdle rates we look at? Do we look at payback period, equity, IRR? Just want to understand that and how we look at it.
So normally we look at a 20% hurdle rate. However, some of the strategic, for example, the investments we are making now are on a, say, 10 to 12 times bigger market size than where we are currently operating. So obviously the investments are large in relation to the current business. So we will have longer gestation time. But we normally look at a steady state after 3 years, which will be the kind of build-up phase that the businesses should run at 20% ROI or ROC subsequent to the 3 years period.
Correct. So, and the other thing, just wanted to understand that obviously this is an industry where clients are reasonably sticky and the barriers to entry are reasonably high, so, and it's obviously helped us with our own India business. But as we look at expanding outside and especially in the States, is that going to be a hindrance and the difficulties? And just wanted to know from the initial reaction of the clients, the customers, are the things going as per plan, ahead of plan, behind plan? Just wanted to understand that.
So initial feedback is quite on plan, I would say. We have the first orders now. We expect them to be executed in the fourth quarter this year and first quarter next year onwards. So the US market, which was the first external or new market initiative, we are now in 18 months starting to see business. Similarly, for Europe and UK, we will start to see more business coming in. So we are on plan. I think we have a good sense on the market where there is green shoots. A lot of business cycles also play a point. So there have been a lot of investments and a lot of growth with the big FMCG, and I think globally and even in India, some of the innovation now is being done by smaller brands which have access to the market with the e-commerce or direct-to-customer approach. So a lot of innovation and a lot of small clients are mushrooming up, and this is a sort of phase where there are new green shoots. So it is in a way a business, fragrance business springtime. A lot of small businesses are springing up at this time. So it is a good opportunity for us to catch them. As you know, existing businesses are quite sticky. So only when there is a wave of new businesses coming up that we see this as a good opportunity.
Good. So the other question was, historically, if we've seen a lot of our global competitors have extremely high ROCs, even M&As that happen in this space have happened at reasonably rich valuations, whereas our ROC right now appears to be depressed. But this, in your view, is just a reflection of the timing of the capex and expansion being done right now, which you think should normalize over the next year or two?
Yeah, so I think one is the expansion investments. Second is the effect of the fire, which has come about the same time when we have sort of looked at the big expansion. So if we had a kind of a hindsight 2020, we may have staggered our investments in the expansion. So we've taken a big bet expansion, and we also suffering from the fire incident, which we need to pay attention and capex to recover and to restore. So I think it's a bit of both. Purely, if it had been normal running in the domestic, we would not have seen such a big stretch on our financials. And we are now well placed. While it's a low position where we are today, I think the market situation and the growth expectations are in place. We have taken, if you look at the history of the company, we've done some organic investments in Europe, inorganic investments in Europe in the past. We have now looked at organic expansion, both in Southeast Asia, America, UK, and Germany. So we are confident to take up entire market without having to overpay or start up with an inorganic sort of approach. So I think the confidence is there that we will be able to turn around and grow in these markets. A lot of the difficult investments around new molecules, captives, processes, innovation platforms that we need for these markets, we have been continuing to build them over the last 2 decades. We have more than 25 patents in all these countries already with us. So that gives us a very strong base when we enter these markets. It's not that we are starting today. So the first patents in the US, for example, are running out in 2030. So we have now only 4 or 5 years to capitalize on this patent cycle before they become kind of public domain. So we see that this is the right opportunity, which gives us 5 to 7 years of trying to push the technology-based, innovation-based business growth in these markets.
Good. Sir, and how much is the receivables that we're expecting from the insurance? And just want to understand, is this a normal? How long the timelines are typically to receive it, and are there any risks to that?
So we are expecting in and around 100 crores, and we don't see a risk on that. The quantum may be plus and minus, but I think we are pretty positive we'll get this money within 6 to 12 months.
Okay, sir.
The second question, yes, the general sense when I talk to some other companies, yes, it does take 18-20 months. In fact, our first claim has come earlier than many other companies in the similar situation. So we are happy about that it is progressed well. We will still, work on it, make sure that it is done timely, and we get the cash flow as soon as we can.
Okay, sir. Thank you. I'll be joining.
Thank you. Next question is from the line of Madhav Marda from Fidelity International. Please go ahead.
Yeah, any thoughts on the top line growth? It's been a bit softer recently. Any specific reasons why that's happening, and when do you expect it to sort of go back to the 12% CAGR, which we guide on a steady state basis?
Yeah, I think the 12% CAGR is still intact. We've seen a bit of softness in the early part of the year in Europe when the tariffs and some of the geopolitical situations were there. Most of this business softness is more from a timing issue. The kind of orders got postponed by a month. So this year is kind of 11 months in the European context. But we are still seeing sales is at the same level as it was earlier in euro terms. India, I had more expectations of faster growth and demand revival in the second half, given the GST changes that were announced in the beginning of the year or second quarter of the year. We have not seen that play out. So we did see some uptick during the Diwali, but after that we are not seeing broad-based demand jump as what we were expecting. In any case, I think the market position we are quite strong. We will be able to recover our sales momentum in India fairly shortly.
So this year, we've at about 11%, which also has first 1Q, which had the low base impact. So going ahead, which markets do you think could do better? Any specific drivers for growth to get to the 12% next 2-3 years?
So our Middle East, Southeast Asia, all these markets are growing very fast. So we don't, this quarter itself, by end of March, probably 12% looks a bit difficult, but we are growing, probably next year will be faster than 12%. I think the 12% CAGR growth still is a long-term thing which we expect to go.
Okay. And then just wanted to check on two more things. One was on our the margin side. Obviously, we are looking to front-end OpEx and spending on these developmental initiatives. So the journey to get to the 17% in 2 years' time, is that all operating leverage coming in, or is it also gross margin? Like, what helps us move from, let's say, 13%, like you're saying right now, to get to 17%?
Yeah, so I think the gross margin, it's a combination of operating lever and gross margin. We are at the low point cycle last year, and we are improving as we go quarter on quarter. We will see gross margin slightly better and operating leverage, both of that coming in. Plus, on the operations, particularly in India, once we stabilize and bring it back to our new factory, there are a lot of logistics and additional costs which we will kind of go back to more efficient operating parameters. So I see these are all operating leverage plus new factory coming on stream, which should benefit us as we look forward. The new markets, as we alluded, first order in the US, we are also seeing green shoots in other markets. So those, when that sort of kicks in, we will see further improvement in the EBITDA.
So have we already reached the peak OpEx spends for some of these new initiatives, or is there some more cost which is yet to come into the P&L?
No, we have reached the peak OpEx. I just want to, I think the OpEx number in INR may change in the currency fluctuations to some extent, but in dollar euro terms, we are at peak OpEx. There will be, so when we say peak OpEx, there is 20 people, couple of people come, couple of people go. This will continue to happen, but there is no big jump which is expected.
Okay.
2-3% plus or minus around these levels.
And the last question on just on the insurance cost. One is, when do we expect the pending receivables which we yet to receive from the insurance company? When do we expect that? And secondly, I think even the insurance cost, which is a bit elevated right now, when do you see that coming down, normalizing to like a more steady state level?
So we have already answered that we are expecting in the next 6 to 12 months to get the insurance money claimed with us. And the higher premium, maybe, I mean, we are trying, but looks like that it might go for a year or so again.
And sir, how much is the money which is due still pending from the insurance company?
We are expecting in and around 100 crore plus minus.
Okay. And the higher premiums, are how much are we spending, which is more than the normal, the premium which we are spending?
So roughly around 13 crore to 13.5 crores we are spending higher than normal in a year.
Okay. All right. Thank you.
Thank you. Next question is from the line of Abhijit Akela from Kotak Institutional Equities. Please go ahead.
Yeah. Good afternoon, and thank you very much for taking my questions. Just the foreign currency impact on the revenue growth this quarter, would it be possible to quantify that? How much of the revenue growth was actually driven by the rupee depreciation?
So vis-a-vis last quarter, I don't think there is much change. Vis-a-vis last year, it's about 10% on the export revenue, so that's been a big jump up. But this quarter we have done 3% growth year on year on the European underlying business in euro terms.
Okay, got it. No, that's helpful. Thank you. And just the the ROW portion of the fragrances, that seems to have grown quite well in the 9 months, from about 215 crores to about 282 or something like that. Are there any specific geographies where this growth is coming from, and what is your outlook for this side of the business?
So Middle East, Africa areas, Central Asia, this is the areas where we are seeing strong growth, and this is linked to also the markets in these areas growing accordingly. So the strong double-digit growth is happening in the Middle East area.
All right. And Mr. Ramakrishnan was kind enough to highlight the total investments on the US side of the business, as well as the expected revenue budget over the next year or so. Would it be possible to similarly call out the investments and the revenue projections for the Europe side, the 2 new centers we are setting up there?
So we have already set up the centers. The centers are in place. We have roughly 2.5 million euros extra cost in the centers, new initiatives that we have taken, and this will support the 45 to 50 million, somewhere around that, which we will end up in this year for the European business. Our new factory factory is expected to be ready in this quarter. So we expect by Q1, probably Q2, it stabilizes in full operations, that gives us another position to aggressively grow the market, because right now we are almost at 85-90% capacity, so we are not aggressive on all the businesses in Europe for growth. We are ready with the new factory. We will be aggressive on the growth rates that we can achieve there.
Okay. And the increase in employee cost this quarter that we see, the 93 crores compared to 85 crores last quarter, is that largely driven by headcount addition, or is it more to do with foreign exchange movements?
It's a mix of all three, Abhijit. It's a mix of some headcount additions, it's a currency impact, and there is some true-up impact as well.
Yeah, sorry, the last component I missed.
A true-up impact on the social contribution.
New labor code.
Okay. Understood. And from here on, I mean, how much of a further increase would you expect in the next quarter or so before, all the investments fall into the base in employee cost?
I think this quarter is fairly representative from the all-in cost on the new initiative. There is no, so all the centers are manned. You will see a couple of people joining, one or two people kind of moving. This is a normal churn, but we don't have any very large sort of addition expected. We do see some relocation movement of people as we have different centers. Some people will move from one location to another location, this kind of thing. But overall cost impact, I don't see additions. I see reorganization where the opportunity is there, we will move the people.
Okay, understood. Thank you so much and all the best.
Thank you.
Thank you. Next question is from Dipanjana Chatterjee from Spark Capital. Please go ahead.
Yeah, hi, good afternoon, sir. I just wanted to understand the linkage between your CDCs and manufacturing facilities. So what I sense is that you have basically three growth engines. One being your manufacturing facilities, second being your CDCs, and the third being your global sales, right? So does the demand arise from the CDCs and the products are manufactured from your manufacturing facilities and then transferred over? Is that how the whole scenario works?
Yeah, so CDCs are the creation development centers which works together with sales and marketing, and these centers develop new business. Operations then satisfies that business. So the operational growth is a capex and a facility, manufacturing facility that supports the growth, but the actual growth comes from the CDCs. So we have put in 3 new initiative CDCs that will generate additional businesses in different geographies and different customer categories. That business, to fulfill that business, we have expanded our manufacturing footprint in Europe as well as in India and Asia.
So currently, what is the installed capacity, if I may ask, overall the company and the utilization rates?
So in Europe, we have installed capacity which is catering to the 50 million and it's about 90% utilized. We will double the capacity, or at least sort of 1.5 times the capacity in the this quarter by end of this year or first quarter next year. In India, we have about, let's say, 20,000 tons of current capacity. We will expand by another 9,000 tons in the first quarter next year and build another 15,000 tons thereafter. We have good amount of headroom within India to continue to grow, so there is no capacity constraint within India while the 2 factories currently are pushing together. And we have additional capacity built in Southeast Asia for 3,600 tons, which will give us another 5 to 7 million of turnover sales in Southeast Asia.
Okay. And the 12% CAGR that you spoke about is between what time frame? Is it between FY26 to 29 or FY26 to 28?
So 25, so 24-25 is the base year, and we will grow at 12% year on year.
12% is your YOY growth being 24-25 the base year, right?
That's correct.
And your return ratios are still on single-digit levels at around 6 to 7%. Are we going to see a double-digit growth post FY28 coming these things turn 55?
ROC, you're talking about return on capital employed.
I'm sorry?
You're talking about ROC?
Both ROE and ROCE. So ROE is in higher single digits. So are we going to see some mid-teens by FY28-29 once these things stand up?
Yes.
Okay.
I expect around 14% is where we will end up in the business.
By FY29?
Yes. For 2 or 3 years, when the new initiative starts to generate cash break-even, we reach the 14%.
All right. And one last question is regarding the EBIT. So what I am noticing is over the past couple of years, your fragrance EBIT margin has remained under higher single digits at around 6 to 8%. And your flavors has quite increased to 20-22%, and it has maintained. So are we going to see this kind of EBIT margins at least till FY27, 28, and then maybe grow further?
On the flavors, as you mentioned, we had a couple of years back quite heavy investments, and we sort of reoriented the business for the next phase of growth in India. So now flavors is at a steady state. The India business, we have put in place all the development center manufacturing capacity and we need. There may be some incremental cost capex as we grow, but it's a steady state business. If we compare fragrances in India, it is very similar and very steady state. The EBIT in fragrances is now depressed and looks different with our investments outside India, and that will take 2, 3 years, 4 years to play out, and we expect that to then be more steady state. It won't be at the same mature level as the India business, but we expect it to be clocking 13-14% EBITDA and improving year on year as we add operating leverage.
So this you're talking about EBIT, right? Because I'm concerned about the EBIT margins. So for fragrance, you're saying it will become 13 to 14% by say in another 2 to 3 years.
But outside India,
okay,
businesses as they ramp up, it will be 13 to 14% EBIT.
EBIT and a blended EBIT considering both India and domestic.
17-18% in somewhere around there. It is EBITDA.
So EBIT. So 17 to 18% is your blended EBIT in fragrance, right?
So we will be EBITDA level 17%. I just got corrected by Jagdish. At the EBITDA level, I'm talking 14% and 17%. At the EBIT level, it will be 2 to 3% higher.
From current 8%, right? In fragrance?
Yes.
Okay. And this flavors is going to remain at around 20 to 22%, if I'm not wrong, because it's steady kind of.
Flavor is a steady state till we are now addressing the India market and some of the exports. At some point, if we look at the Southeast Asia, Middle East or European business, then we will invest. Once the fragrance investments have started to play out, we can look at expanding the flavor business globally.
Okay. That's all for me. Thanks.
Thank you. Ladies and gentlemen, we'll take the last question from the line of Bharat Seth from Quest Investment Managers. Please go ahead.
Hi. Kelkar, you said this which new factory will start, Q1, and the one which was under fire will start. So when do you expect to start?
So first, the new facility will start in Q1, and the one which is in the fire, we probably have the building ready, and when we migrate the first factory, then probably next year, first calendar quarter, first quarter or fourth quarter next year, we'll start the migration.
Okay. To understand more on this gross margin, how much pricing power do we really have? So that to mitigate input costs.
Yeah, so most of our products, 85% of our products are proprietary. We have very good pricing power on being able to pass on the cost increases to our clients.
Now, what is the real issue that we are not able to really improve the gross margin? I mean, as you were anticipating.
There is no real issue. Things are improving. I mean, the numbers are a bit time lag, but otherwise things are improving.
One question for Jagdish. You have the amount of outstanding GST receivable. So what
Sir,
is
sorry to interrupt you. Bharat, there is a bit of background noise from your line. Can you please move to a different location, please?
Yeah, sure. So, hello. Now am I clear?
Yeah, I got your questions. You are talking about GST refund, right?
Yeah.
Okay. So we are working on that, and I do expect we should see some positive on that in 3 to 6 months' time.
Already seen.
Yeah.
But what was stuck, I think the orders are in our favor, and the GST refunds have started to come. At one point, at the high point, roughly 50 crores of GST for exports was stuck in the appeal or in the clarity on the basis. I think the GST refunds have started to come in. So this may be every month, every 2 months we are getting refunds, and this 50 crores expected to be brought down to normal levels in a couple of months, maybe 6 months.
Thanks. Thanks and all the best.
Thank you, Bharat.
Thank you very much. With this, I now hand the conference over to the management for closing comments.
Thank you. I hope we have been able to answer your questions satisfactorily. Should you feel any further clarification, please reach out to the company or feel free to contact our team or CDR India. Thank you once again for taking the time to join us on this call.
Thank you very much. Thank you. On behalf of SH Kelkar and Company Limited, that concludes this conference. Thank you for joining us, and you may now disconnect. Thank you.